the incentive to move the market. If you remember last time, I was talking about how the market maker doesn't really have an incentive to push the market around. Okay, so what I want to talk about is what does that exactly mean? Okay, how do I make that, how do I turn that around and actually make some money from that? Well, let's talk about, first of all, when the market maker can push the market around. And I want to focus on one small area of the chart right here. And if you remember from a couple of days ago, during the daily video, as the market was pushing its way up, I was looking for a breakout. And I was looking for a breakout above that little high there. In fact, let me erase these. So I was looking for a breakout above this high. And if you remember, I came back with an update and said, this is basically a bust, and the market is really slowing down. It was getting towards 12:30 in the afternoon, and the momentum was just over. The move had started much earlier, and it wasn't able to follow through. And that can happen. But then look at what happens over the next few hours. You can see that the market really dies down here. It goes into a much smaller range. And in fact, you can see the difference when I put these lines on the chart, just how much different they are. Okay, in one case you have a market that's going up like this, and in the next case you have a market that's actually going down, but it's going down like that. So we have a flag pattern here, and this flag was forming into the Asian session. Okay. Now I put on the bottom here a volume histogram. Okay, so this is the volume. One of the reasons why I like to use the Ensign Windows package is it enables me to get volume from eSignal. And I'm going to put this on the chart for a short amount of time because I just want to illustrate a point. You can see how the volume is initially pretty high. And then as the market starts to die off, you can see how the volume really drops off. In fact, the volume goes from about 12,000 contracts per hour down here to about 2,000 contracts per hour. So there are 2,000 lots, pardon me. So you have a big drop in the total number of trades that are going on. Now, when the market makers are going to push the market around, it will invariably be during these very low volume times. Okay? During these high volume times, it's next to impossible because the market is simply going to be moving too fast for them to even be bothered with trying to push the market where they want it to go. So that's one criteria. One criteria is that there's a low volume, low volatility time in the marketplace. I'm going to get rid of the volume now. And the reason why I don't talk about volume in the kit or very often is because not all traders can get a good picture of what the traded volume is. Okay, so in order to make sure that we're all in the same playing field, I simply skip over it. But there is a way that you can look at the marketplace, and actually one of the members, Jeff, and I were talking about this today. One of the ways that you can get I would say, an even better picture of what's going on is by simply looking at the bars. Okay, in this area here, when the market is moving up, you can see that the bars are pretty large. Okay, from high to low, these are pretty big bars. Okay, there's one little one in the middle here, but high to low, you've got some pretty good ranges here. So you can equate that to, if it's a liquid market, especially like the pound, you can equate that to a higher than normal or an above average time of volume. When you see that the market has very small bars like this, I mean, these bars are absolutely tiny. In fact, I've seen it where from high to low, you may have a 5-pip range on the pound. It just gets dead quiet. It's rare, but it can happen. Usually what will happen is these ranges will come down to about 15 pips or so when the market is in